On July 11, 2008, the Office of Thrift Supervision posted a closure notice on the glass doors of IndyMac Bank's Pasadena headquarters. For 3 days, depositors had lined Lake Avenue, withdrawing approximately $1.3 billion in the second largest bank failure in United States history to that point. Inside, the institution's books still carried interest income that no borrower had ever paid in cash. That income existed only as a number, a growing addition to the principal balances on the bank's option adjustable rate mortgage portfolio. This episode answers how a federally insured thrift could recognize as current revenue interest that had never been collected and in many cases never would be, and how that treatment was a permitted application of the rules rather than a violation of them. At the center of IndyMac's income statement was the option ARM. The record establishes that a typical option ARM offered 4 payment options on a single monthly statement: a fully amortizing payment over 30 years, a fully amortizing payment over 15 years, an interest-only payment which reduced no principal, and a minimum payment calculated using an introductory rate deliberately set below the actual interest rate on the loan. The fourth option defines the instrument. The minimum payment was computed from a teaser rate, often between 1% and 2%, while the note rate at which interest actually accrued might be 6%, 7%, or 8%. The gap between what the borrower paid and what the loan charged was added to the principal balance. The borrower owed more at the end of the month than at the beginning. This is negative amortization. Under generally accepted accounting principles, the unpaid interest is capitalized, added to the asset, and the accrual basis of accounting requires a lender to recognize interest income as it accrues, not as it is collected in cash. So when a borrower made the minimum payment and the loan balance grew, the lender was permitted, and in fact required, to book the full accrued interest as income. The portion paid in cash arrived as cash. The portion not paid was recorded as income anyway and simultaneously added to the loan balance as principal owed. Income statement: revenue rises. Balance sheet: assets rise. Cash flow statement: nothing arrives. This was not in itself fraudulent. A construction loan, a student loan in deferment, a zero coupon bond all accrue interest paid later, properly recognized as it accrues. The legitimacy depends on a single assumption that the accrued interest is collectible. The option ARM was built around the expectation that the borrower would refinance before recast, or that rising home values would build enough equity to absorb the growing balance. Most option ARMs recast when the balance reached a negative amortization cap, commonly 110 or 125% of original principal, or after a fixed period, often 5 years. At recast, the minimum payment option disappeared. The loan re-amortized at the full note rate over the remaining term. Monthly payments could double or triple overnight. The legitimate version requires the lender to carry a realistic estimate of how much capitalized interest will actually be paid, flowing through the allowance for loan losses. Income recognition and loss reserve are supposed to move together. The structural failure is what happens when they come apart. The income recognized in full, the reserve lagging. That gap is where the appearance of profit lives, with no cash behind it. IndyMac Bancorp was the holding company. IndyMac Bank, FSB, was the Federal Savings Bank subsidiary, regulated by the Office of Thrift Supervision. It had built itself into one of the largest originators of Alt-A loans in the country. Alt-A is the category between prime and subprime, defined less by credit score than by documentation. The borrower often had a reasonable credit score but provided reduced documentation of income or assets. The stated income, low doc, and no doc products lived here. IndyMac specialized in these loans and in the option ARM as a flagship product. The business model had two engines: origination and sale, packaging loans into mortgage-backed securities, and booking gain on sale. And, relevant here, the portfolio held on its own books. IndyMac retained a substantial volume of option ARMs as held for investment assets, generating the accrued interest income described above. Step 1 in the architecture: origination at scale with minimal verification. The SEC's enforcement record establishes that IndyMac was originating option ARMs and reduced documentation loans in enormous volume through 2006 and 2007, precisely as the housing market peaked and began to turn. The qualification standard for many loans was the borrower's ability to make the minimum payment at the teaser rate, not the fully amortizing payment at the note rate. Step 2. The income statement filled with accrued, uncollected interest. As more borrowers selected the minimum payment, each generated a slice of capitalized interest recognized as income. The bank was, in effect, lending borrowers the money to pay it interest and recording that interest as earnings. Step 3. The deferred interest became an asset on the balance sheet. The accumulated negative amortization sat in the carrying value of the loans. As the portfolio aged toward recast, this deferred interest asset grew. Step 4. Load-bearing for the entire institution. Capital adequacy. Capital ratios are computed against assets and earnings. Reported earnings, including accrued, non-cash interest income, supported the bank's capital position through retained earnings and through the appearance of profitability that let the bank raise capital and attract deposits. The brokered and high-rate deposits funding the loan book depended on the institution presenting itself as profitable and adequately capitalized. By 2007, home prices in IndyMac's core markets, heavily concentrated in California, were falling. The exit assumptions, refinance or sell into a rising market, disappeared simultaneously. Refinancing requires equity, and equity was vanishing as prices fell and negative amortization pushed balances above original principal. A borrower could now owe more than the original loan on a house worth less than the original price. This is the structural vice. The accrued interest recognized as income was becoming uncollectible, but it had already been booked. The income was in past statements. The asset was on the current balance sheet. The SEC's enforcement actions focused not on the option ARM accrual itself, which was permitted, but on the integrity of the capital and disclosure picture presented as the portfolio deteriorated, specifically the backdating of a capital contribution. In May 2008, IndyMac Bancorp made a capital contribution to the bank subsidiary. The SEC's record found this contribution was recorded as though it had occurred in the quarter ended March 31, 2008. The effect was to make the bank appear well capitalized as of that quarter's close, when the capital had not yet been contributed. The Commission characterized this as causing the bank to file regulatory reports that overstated its capital position. This is the moment the accounting structure stops being a permitted treatment under stress and becomes a misstatement. Look at the full architecture. A loan product that generates income before cash. A growth strategy maximizing its volume. An income statement increasingly composed of non-cash accruals. a balance sheet swelling with deferred interest, a capital position resting on those earnings, and when collectibility collapses, the management of period-end appearances. The bottom layer is the assumption that the borrower will pay. Begin with the external auditor, whose role is to assess whether the accrual is appropriate and whether the loss allowance is adequate. Historical loss data on option arms originated during rising home values showed low realized losses because borrowers in trouble simply sold or refinanced. An auditor reviewing a reserve methodology grounded in recent experience would find that experience benign, precisely because the conditions that produced low losses had not yet reversed. The verification chain relied on backward-looking loss data to validate a forward-looking estimate in a product whose entire risk profile was concentrated at recast. Second, the analysts. The accrual was disclosed. Sophisticated readers could calculate the portion of reported income attributable to negative amortization, but disclosure is not detection. As long as the institution reported profitability and adequate capital, the disclosed accrual was read as a known feature of a viable business rather than as evidence of an income statement filling with uncollectible claims. Third, the regulator. The OTS's primary tool is the Capital Adequacy Framework, computed using reported figures. When the central question is whether reported earnings and capital are real, a framework that takes those figures as inputs has limited ability to detect the problem from inside its own arithmetic. The backdated contribution is the sharpest illustration. The mechanism for keeping the bank classified as well capitalized was a manipulation of when capital was recognized, aimed directly at the metric the regulator used. A Treasury Department Inspector General report examined the IndyMac failure and the regulator's role. The findings on the backdated contribution implicated supervisory conduct and drew significant criticism of the agency's oversight. Fourth, the metric itself. Net interest income and net interest margin are reported on an accrual basis. For negatively amortizing option arms, accrual and cash income diverge by exactly the amount of capitalized interest. The standard metric reports a profitability that includes money the institution has not received. Now, the unraveling. By early 2008, delinquencies were rising across Alt-A and option arm portfolios industry-wide. Home prices in IndyMac's concentration markets were falling materially. Borrowers approaching recast could neither refinance for lack of equity nor sell for lack of a buyer at a price covering the swollen balance. The funding model added fragility. IndyMac relied heavily on deposits, including brokered and high-rate accounts that were rate-sensitive and flight-prone. The asset side was illiquid and deteriorating. The liability side was liquid and nervous. That asymmetry is the classic structure of a run. On June 26, 2008, a United States senator sent a letter, made public, expressing concern about IndyMac's solvency. A public statement of doubt from a credible source converts diffuse anxiety into coordinated movement. In the 11 business days that followed, depositors withdrew approximately $1.3 billion. An institution funding a long-dated, illiquid, deteriorating asset book with short-dated deposits could not meet the demand. On July 11, 2008, the OTS closed IndyMac Bank and appointed the FDIC as conservator. The deferred interest asset, the accumulated negative amortization recognized as income over the preceding years, now had to be measured against what borrowers would actually pay and what collateral was actually worth. The gap between booked income and recoverable value was a realized loss to be absorbed in resolution. The SEC's investigation of the holding company and certain executives resulted in settled enforcement actions addressing the disclosure and capital misstatements, including the backdated contribution used to present the bank as well capitalized as of the close of the first quarter of 2008. The parties neither admitted nor denied the findings, the standard form of an SEC consent resolution. The accrual of option arm interest was the engine that had built the picture. The backdating was the act that tried to hold the picture in place when the engine stalled. Trace the collapse. Income recognition depended on collectibility. Collectibility depended on home prices and refinance availability. Both failed. The accrued income that inflated past earnings was revealed as claims against borrowers who could not pay, secured by collateral worth less than the claims. The deferred interest asset had to be written down. The capital those earnings had supported was therefore overstated. The order of collapse was the reverse of the order of construction: the income, the asset, the capital, the deposits. What does the case establish? First, that the accrual recognition of capitalized interest is only as sound as the collectibility assumption beneath it, and that for an option ARM portfolio, that assumption is concentrated at recast under conditions that have not yet occurred when the income is recognized. The instrument recognizes revenue years before it tests whether that revenue exists. Second, that the divergence between accrual income and cash income is the diagnostic. Where reported interest income substantially exceeds interest collected in cash, the difference measures the institution's exposure to its own collectibility assumption. The detection failure was a failure to make that disaggregation the primary lens, not a failure of available information. Third, that capital adequacy frameworks built on reported figures are circular when the question is whether the reported figures are real. The metric that determined regulatory health was the metric manipulated because it was computable and controlled by the supervised institution. IndyMac's failure was among the events examined in the post-crisis review of thrift supervision, and the Office of Thrift Supervision was subsequently abolished, its functions transferred under the Dodd-Frank Act of 2010 to the Office of the Comptroller of the Currency and other agencies. The option payment arm, as originated in the IndyMac era, did not survive the subsequent regulatory and market response. The findings are these. The income was recognized as the rules permitted. The asset grew as the loans were structured to grow. The capital rested on the income. And when the borrower could not pay the interest the bank had already counted, the institution had, on its books, money that existed only as a larger claim against people who could no longer pay it. The closure notice on the glass doors was the moment that claim was finally measured against the cash. The record is closed.